Hi, I'm Steve Jubin, Head of Credit Suisse Asset Management Australia and also Equities. And today I'm going to talk about the Australian Share Fund. But firstly, the markets. The Australian share market was down 10.4% for the September quarter. Notwithstanding a rally post the August reporting season, the market sold off very aggressively in September in the midst of the global financial crisis. In terms of sectors that did best, clearly defensive sectors such as healthcare and financials, and the worst performing sectors were materials and energy. The Australian Share Fund was down 6.4% for the quarter compared to the market, which was down 10.4%, meaning that the outperformance was quite significant at a little over 4%. The fund continues to outperform on both a 1 and a 3-year basis. In terms of the major contributors and detractors to the fund for the quarter, in terms of the contributors, stocks we own, such as David Jones, Woolworths and Westpac, were quite positive. It was also positive we had no exposure to Fortescue Metals and Wesfarmers. On the negative side, holdings in BHP and Rio Tinto, stocks that we own, were negative detractors, while stocks we didn't own, such as QBE and CSL, were also major negative contributors. The major issue in the quarter was clearly the global financial crisis. We saw a number of bankruptcies. We saw bailout packages in the US and in Europe. We saw in the UK government ownership of banks. We saw the government also providing some equity capital in the US. We've seen deposit guarantees. We've seen funding guarantees across the board. It was quite a tumultuous period, particularly September. In terms of the credit rationing, obviously that will have an impact on economic activity, and clearly we're starting to see signs of that in the US and parts of Europe. China has basically been sort of immune to some extent, although it is also slowing down at this point in time. Net exports will have some impact because of the weaker European and US economies, but we're still reasonably confident that that economy can grow at sort of high single-digit rates into next year. In terms of the impact on commodities, it had quite a devastating impact. We saw commodity prices down between 20 to 30%. Oil prices were off 30%. They've fallen another 30% in October. We've seen base metals off 20 to 30%, and that's impacted things like Australian dollar, which has also fallen 17% during the quarter. It's down nearly that much in the month of October to date, trading below 70 cents to the US dollar. As a consequence, we saw interest rate cuts across the world. In Australia, we originally cut 25 basis points early in the September quarter, and then more recently 100 basis points or 1% cut. Ironically, reporting season, which occurred in August, was reasonably tame compared to the aftermath of the credit crisis. Generally, there were no big surprises, and most companies were less bearish than some of the expectations in the market. In terms of the impact of everything that's occurred during the quarter is that clearly world growth will slow. Some areas will be in recession and others areas will slow dramatically. That's going to be a negative for commodity prices. Notwithstanding they've fallen quite a long way already, we see the next impact to be felt in the seaborne commodities such as iron ore and coal. That will also have an impact on the resource sector. So we'd see a little bit more downside in that area. In terms of the Australian dollar, clearly weaker commodity prices will have an impact on the currency. It does look like it's probably overdone in the short term. There are technical factors why the Australian dollar is as weak as it is. But notwithstanding, we'd see it on average being lower than where it was, which is going to be positive for offshore earners. And the market as a whole benefits from a weaker Australian dollar. In terms of interest rate cuts that we've had to date, and I think we'll see more to come, that'll clearly aid cyclical sectors such as building materials. It also helped the financials. In terms of the portfolio's positioning, we maintain our bias towards the quality end of the market, companies with good business models and strong balance sheets. I think in this deleveraging phase, which is going to continue for quite some time, the market will continue to reward companies that have very strong balance sheets. Banks have performed pretty well so far, but they'll benefit further from the interest rate cuts we expect to continue. And certainly from the recent initiatives from the government in terms of guarantees for both deposits and term funding. Some value is starting to emerge in the cyclical companies, which have been punished by the market recently, so we'd start to see some opportunities emerging there. We remain cautious towards infrastructure and property trusts, given the ongoing deleveraging. And we maintain our overweight in industrials and underweight resources. Given the sharp fall we've seen in the market over the last 12 months, the issue, what can we expect going forward? Well, we look at a couple of things. Firstly, valuation. The valuation of the market is historically low. It's around 9 to 10 times earnings, which is sort of at levels pricing in a recession. In terms of the earnings side of the equation, we'd see them being flat from here for both industrial and financial stocks. However, the easing monetary policy that we expect to continue should reduce some of the pressure in this regard. Clearly, the slowing global growth and commodity price weakness will continue to place pressure on the resource sector, so that will detract from the overall market performance. And clearly the volatility will remain until we get some sort of return to normality, in particular in terms of credit markets. We need credit markets to work, so lending can take place, so economic growth can actually start to pick up down the track. As always, it's important to focus on good quality companies that are attractively priced, and they should continue to outperform going forward.